Well, let's get more on that surprise trade deficit again out of Australia and get over to Sydney. We did have that data just crossing a short while ago, just about 13 minutes ago. Most economists we talked to, including our guests, are actually expecting a surplus. Stephen Walters is Chief Australia Economist at JP Morgan, and he joins us now from, as I said, Sydney. Okay, thanks a lot for joining us there, Stephen. Let's, why did we get a deficit?
Yeah, good morning. Yeah, quite a disappointing number. We thought the export numbers would be pretty solid, but in fact exports were down about 2%. Admittedly, imports were down as well, but yeah, the disappointment was really on the export side. We thought you'd get quite a rebound, particularly in some of those big bulk commodities, but in fact coal exports were off quite a bit, and also farm exports off a lot. So we were quite surprised. We thought we'd get a surplus up towards the $1 billion mark, but in fact we're still in deficit. So yeah, quite a disappointing number.
How's the Reserve Bank going to interpret this data?
Well, I think like us probably find it a little bit disappointing, the fact that we're still running trade deficits, even though we've got this quite a bit of obviously very high profile weakness in some parts of the domestic economy like manufacturing and tourism. That we're still getting import growth faster than export growth is quite disappointing, and I would have thought, given some of the improvement in some of the global growth numbers, and not necessarily out of China but out of other parts of Asia, we know growth there has been quite weak, so you would have hoped to have seen better export numbers to those regions, and yet we're not getting them, so a little bit disappointing.
Yeah, you mentioned China there, and of course it's the biggest trading partner for Australia. So what is the read-through, Stephen, of what's going on in China from these numbers?
Yeah, well, clearly there's a slowdown going on in China, and I think we all acknowledge that now, that some of those PMI type numbers and the industrial production numbers have been a bit soft. But okay, we're still looking at growth of somewhere between 7 and 8%, so let's keep that in perspective. That's pretty solid growth. But clearly there's a bit of downside probably still to come in China, and our economists acknowledge that the growth in Q1 and Q2 is going to be somewhere closer to 7% than 9%. So I'd anticipate that means some of our export numbers out of Australia to China actually weaken a little bit, because our big bulk commodity exports, a lot of them do go directly to China, and admittedly some of the numbers out of the ports that we can monitor here, so before they get put through the hoops by the Statistics Bureau, we actually can track those numbers straight from the port authorities, and they looked okay sort of heading into November, December last year, but admittedly the January-February numbers have softened a little, and I suspect you'll get more of that over the next 3 to 6 months. But later in the year we do actually anticipate quite a strong rebound in China. So again, let's not get too carried away with 1 month's weak numbers. I think later in this year you'll get much better export numbers, not only to China but to the rest of Asia as well, including even Japan.
Yeah, Stephen, let's talk about the domestic side of the economy then. What about domestic consumption? We've seen some weakness definitely when it comes to housing. You know, what is happening with this so-called two-speed economy?
Well, I think it's getting worse, and okay, we didn't get the evidence of the good part of the export economy today, but I think what is clear is that we still have this very big mining investment boom going on in the background, but the benefits of that seem to be a little intangible at the moment, and I think the problem for, you mentioned housing and even consumers, is that they know this boom's going on, and they hear all the anecdotes from the mining states like Western Australia and Queensland about how big this boom is. But what they see right in front of them is job losses in some pretty significant parts of the economy, like the retail sector and manufacturing and banking and tourism, and I think what's happening is it's dragging on their sentiment. So consumers are feeling a little bit downbeat, and they see what's going on in Europe, and they see the slowdown in China, and I think they're just feeling a little bit under pressure, and their wealth's down, their house price probably is falling still, equity markets haven't really rebounded from the lows that we'd hoped there'd be a much bigger rebound. It hasn't really happened. So I think consumers just feel a little bit fraught here and a little bit cautious, and for that reason they're saving a lot of their income. In fact, the savings rate's still pretty close to 10% of income. We haven't seen those sort of savings rates sustained since the 1980s. So yeah, I think it's just this multi-speed theme is going to continue for quite a long time.
Stephen, thanks for your time. Thanks for stopping by. Stephen Walters there from JP Morgan, Chief Australia.